So you are working with a target client. What does advisory look like? What is the type of work that we do? What is the type of advice that we give? What are the type of reports that we generate for clients? What problems do we solve? So let's talk about that in this last section, the unique industry needs and examples. So industry specialization works because, again, you're working with similar clients. You will have insight of how the industry works. You can easily translate insight into foresight, which means what I understand, what could possibly happen, right? Can we do forecasting for our clients? Knowing the lingo, the jargon, the terms, whatever you want to call it, will help you describe their issues. Because once you understand what they're talking about using their lingo, then you understand what the issues are. Chart of accounts and item lists are going to be similar within an industry. So you can find specific information in reports much easier with a standardized item list, a chart of accounts, or working with very similar ones. And also, you can develop your own proprietary KPIs, custom reports that you can test across multiple customers in the same industry. And then that could be part of the unique thing that you do. You create those unique reports, those unique insights. Now, let's discuss the type of data that we collect, that we prepare, that we process, and we present. Present means we report on, right? So we start with a simple one, financial data. We should have access to that. We have access to their books as accounting professionals. So these are going to be sales, expenses, all that data. Now, we should also be collecting some sort of non-financial data. So, such as, number of days between events. So we do some sort of marketing campaign every 90 days. That would be interesting to know. So you can tie in your sales with that marketing campaign. Or we do a new product launch every 18 months. That would be interesting for you to know. So you can see the cycle of the sales after the product launch and nearing the new version of the product, whatever it happens to be. Or we have seasonality, right? So we have restaurants that are busy in December, not so busy in July. That non-financial data is important to understand, not just sales, but just understand that there's less physical people walking into these restaurants and that sort of thing. Now, number of customers that walk in a store, number of phone calls that the customer is getting, right? Number of leads the customer is getting. That's all non-financial data that we can bring in and collect so we can try to draw some correlations and maybe create a unique API, right? That sort of thing, right? What about non-empirical data? So that's an interesting one. This would be more like anecdotal data. And these are like feelings, expectations, and projections. So do we know what customers are feeling about a particular industry, about a particular product? Can we bring that into the fold? Can we ask the employees of the business, hey, what are your feelings around sales in October, right? And so we can collect that data too, so we can try to compare sort of real facts, non-financial data, financial data, with their expectations, customer expectations, employees, even the business owners' expectations or projections or feelings of a particular type of client, a particular event, a particular industry, that sort of thing, right? The big virus, the pandemic, drew all sorts of different opinions and feelings that were pretty strong. Customers, business owners, employees. So collecting that data will help you adapt or compare the numbers and see, look, is it true what they say or what they thought of how this was going to affect us? Many industries thrived during the pandemic. So it's not that everybody was feeling doom and gloom, therefore it was doom and gloom for everybody. That's not true, right? So that's an important concept to make sure you keep in mind, right? That what people thought or feel or expect can be confirmed against the reality afterwards, or can be compared against a different reality. And that's valuable information, something that generally an advisor it's in a much better position to give than someone that's, in the inside of the business, again, because they're mired or tied or anchored to those feelings. And they will double down on that or find a way to justify their expectations with some trivial data and latch onto that, right? Because they don't want to be seen as they were wrong, or they saw things, they didn't see things complete. So being able, you as an outside advisor, tying in that information, it's really valuable. Also, could you add in your own observational experience? What have you seen with other businesses? What have you seen? What does your experience tell you? And combine all that non-empirical data into one data set. And the last one would be benchmark data. So is there published data of similar companies, similar industry, financial, non-financial, anecdotal, whatever it happens to be, out there? And can we also pin it against, this is like, some people call it industry averages. So can we look at the results of the business? Can we look at non-financial data? Can we look at budgeted data, anecdotal data, feelings and expectations and projections, and industry averages, and combine all those things to provide advice, not just with historical financial data, think beyond historical financial data. So this is where we take that data and we create reports, we create KPIs, and what are the tools that are out there? What are the type of advice that we can give? And this is really split into four. One is hindsight. And hindsight means presenting historical financial statements, profitability reports, information of what happened, historical data. Nothing wrong with that. It provides very little insight of the future, but it provides a clear history. That's hindsight. Next one is oversight. So are we verifying that the data that's being collected, it's accurate? Are we verifying that it's complete? Are we verifying that the workflow to collect that data has enough controls to assume we don't get bad data? Because remember, you get bad data, you're going to have wrong reports. That's going to give you wrong KPIs, wrong insight, wrong foresight. Everything will be wrong. So can you provide oversight, helping your clients collect that data properly? So control is usually they call them controls, accounting controls, data entry controls, data collection controls. Okay. Could you provide some observational data, what you're observing by seeing the employees work, seeing the employees enter data into the accounting system, into spreadsheet, whatever it happens to be. That's oversight. The third one is insight. Insight is when you combine the information you get from the hindsight with key learnings from your field experience that will translate that data into wisdom. Insight is the wisdom of the advisor, right? Taking data, taking information, and converting it into wisdom, actionable advice. Okay, what does this data mean? That's the wisdom an advisor can provide. Okay, so you're going to tie in financial and non-financial data to tie in those two. And the last one is foresight, which means, look, based on the insight and the wisdom that we're providing from understanding observational data, real data, financial data, non-financial data, taking all this information. Taking all this information and what can we create for the future, what actionable plans, what budgets, what forecasts, what can we do to ensure that we get to the future that we want? Going back to the unique positioning statement, we had a desired future state that we talked about. We paid lip service to this is what we do, this is how we help people do it. This is what it looks like at the end. We give people that foresight. Now that could be done with benchmarks, that could be done with anecdotal data, that could be done with budgets and forecasting. We're going to tie in behaviors, future behaviors with future results. I'll give you an example. Okay. So I used to work for Best Buy very long time ago, before I was an accountant. And I had a really wise supervisor that kind of shifted the salespeople in the store based on the results. So if they're having a day, a week, a month in which they have a very low attachment rate, an attachment rate would be like selling a printer with an ink cartridge, selling a laptop with a laptop case, right? So not just selling the core product, but selling one more sort of high margin product attached to that to increase the overall margins of the sale. So when attachment rates were low, when the margins were running low, the supervisor would say, all right, we have a strategy in place to increase that. And what they did is they said, I want to start recommending 2 ink cartridges per each printer that leaves the store. And the way we do that is we're going to man the printer aisle. We're going to put a person in the printer aisle. We're going to put a salesperson, man or woman, right? But that's what they call it. We're gonna have a person in the printer aisle, and they don't leave the printer aisle. So they used to tell me, Hector, you're gonna hang out here. You're not gonna leave this aisle, and your job is for every single person that buys a printer to recommend 2 ink cartridges. And when they ask you why 2, you can say, hey, let me ask you a question. Last time you ran out of ink, did you actually have a replacement cartridge, or did you have to run like a maniac trying to find it in the middle of having to turn in a project, some work for the next day? So you always want to have your ink cartridge and a backup. So simple, right? So this person, my supervisor, devised a very specific actionable plan with specific behaviors that made that salesperson take a very specific action in order to get a desired result, which is higher margin, a larger attachment rate. So attachment rate is a KPI that we build, right? Margin is the bottom line that we're looking for, more profits. And the behavior that we shape, that we suggest, that's how we transform the client into being a proactive, action-based small business that uses, again, the insight and the hindsight, uses all that stuff to then devise actions that change or shape the future. That's what an advisor can do. Help your client think about that. Okay, so just an example. All right, let's move on to, let's say, so that's like a retail example that we throw in as a bonus. Let's talk about a construction company. So let's talk about some of the things that, type of advice that we give to a construction company, just to further the examples that we're doing here. So, for example, for a construction company that has hindsight needs, right, reporting needs, historical needs, there are 2 types of reports that we as advisors and accounting professionals help people create. So, estimates versus actual by job. This is where you take your lump sum project, budgeted costs, labor, materials, overhead, and you project them. And you say, look, I think that for this project, I'm going to spend this much in labor, this much in material, this much in overhead. And if I spend that, I will mark that up, whatever, 25%, and I will have a profitable, quote unquote, a profitable job. So knowing ahead of time what your costs are going to be, knowing ahead of time what your markup is, and tracking those expenses by job, by labor, materials, overhead, by the specific category, let's call it that, or the specific item, will provide a detailed estimate versus actual report. And you can go back to your client and say, let's look at this job, how this job is doing, how this job went, so you can learn from it. And if you can realize that, yes, we made a mistake estimating this job, and the reason why we make a mistake is because we didn't ask questions A, B, and C. Next time a new job shows up that looks like this, we're going to be more careful on our cost estimation, our markup, or our pricing. That's how you take the insight from a job estimate versus actual report and you turn it into foresight or insight so your customer can make better decisions for pricing or bidding those jobs in the future. Something as simple as a hindsight report like that opens up the floodgates for that type of advice. The next one is a percentage of completion by job report. It's very, very valuable for a construction company. This will give you the percent that the job is completed based on estimated costs versus actual costs. So if you have a lot of jobs that are 50, 60% done from an accounting perspective, but then you observe that they're only like 10% or 20% done from a real physical perspective, then there's a huge disconnect between your budgeted costs, your actual costs, And that could give you an indication that these jobs are going to be unprofitable. So this is the type of examples of the type of reports that we help our clients create so they can make better decisions and we can give them that insight and that foresight. Let's talk about moving on within construction company. What are the insight type of reports? And this is the stuff that we've been talking about. So job profitability by project type. So if we can give them a report that shows them which type of projects, commercial, residential, government, right? Whatever type of construction they do, new construction, remodeling, whatever it is. Can we tell them historically which of these jobs are more profitable, right? And knowing or not knowing, again, knowing or not knowing whether these jobs or types of jobs are profitable or more profitable, will that change your behavior, right? As to where are you going to bid more of these jobs? Are you going to price them higher and you don't care about losing them because they might make you lose money anyway? Are you going to focus just on one type of job? Are you going to invest in doing the type of job, marketing more towards that type of job, retooling and training your employees to focus on one type of job or becoming better at doing one type of job? So all these things will drive behavior, drive changes, drive management decisions because you're providing that insight, right? So which jobs make more money than others or type of jobs. Another type of report that we generate is a committed cost report or cost to complete report by job, similar to the percentage of completion report. But this one tells you more about, okay, what's left? How much more money are we going to have to spend to complete these jobs realistically? Are we going to be over budget? Are we going to be under budget? Do we have to generate a change order? Did we make a huge mistake in estimating something? Do we need to go back to our customer and talk about cutting costs somewhere because we went over in a particular area? So a committed cost report or a cost to complete report tells you about the future. Okay. What about some foresight type of reports? Again, within the construction industry. So you can have cash flow forecasting. So you can achieve this typically, basically by looking at the contractual obligations. Okay, when is the customer supposed to make the next couple of payments? And can you schedule that out? Can you project when that cash flow is coming out? Can I do the same thing for vendors, right? So payables planning. So the vendors, the subcontractors, the materials, all these things that I have contracted or will contract, based on all the due dates, can I project out how much money is going to be paid out? So could I do a simple cash flow forecast and payables planning to figure out if I will have the cash flow or will I need to inject the company with some capital or talk to vendors to delay those payments or talk to customers to try to speed up those payments, that sort of thing. Okay. What about some foresight type of reports? And we talked about this already, but again, on the foresight category is, look, if you look at the actual cost versus the estimator's projected cost, and you look at the variance, could you coach or suggest your clients to coach some of those estimators or train them on how to estimate better? So if you have a particular estimator, a particular group of estimators that are underbidding the jobs, or maybe even overbidding the jobs, because overbidding could effectively lose you some deals, right? So they're all underbidding the jobs, we're losing money. If we're overbidding the jobs, it's great because we're probably making more money, but we might be losing jobs because of overbidding and competitive pressures. So being able to do this type of analysis at the estimator level to give the small business owner, the construction company's owner, the tools to make future foresight decisions, that's going to be really valuable. What about job or bid approval? Again, we talked about that just now. How many jobs are you losing that because they're not being approved, right? Maybe because you're overbidding them, right? So do we want to continue to bid on jobs like that in the future, or do we want to change our bidding process so we can win more? All that stuff is foresight looking type of reports. Okay, so let's do the next polling